4 assets that doubled in every major recession. Imagine this: 2 neighbors, same age, same job, almost the same salary. For nearly 20 years, they both invested every month. Neither of them was rich. Neither of them had a financial advisor. Neither of them could predict the future. Then, 2008 happened. One of them opened his investment account and watched almost $380,000 disappear. The other guy? He lost money too, but by the time the crisis was over, his portfolio had already started recovering. A few years later, he was worth more than he had ever been before. Same country, same economy, same recession. Completely different outcome. So, what did one guy understand that the other didn't? Here's the interesting part. It wasn't luck, it wasn't insider information, and it definitely wasn't perfect timing. It was history. Because if you study the biggest financial disasters in American history, you'll notice something most people never talk about. Money almost never disappears. It moves, and surprisingly, it keeps moving toward many of the same places, again and again and again. That's what this video is about, not predicting the next crash. Nobody can do that consistently. Instead, we're going to look at what actually happened during America's biggest economic crises, where money historically flowed, why it moved there, and what that can teach us today. Because every generation believes this time is different. History usually replies, not as different as you think. Let's meet our 2 investors. We'll call them Ryan and Chris. Ryan loved exciting investments. If everyone was talking about a company, he wanted to own it. If a stock doubled, he wanted in. His philosophy was simple: buy what's winning. Chris invested too, but he looked at things differently. Instead of asking what's popular, he always asked, what happens if everyone gets scared tomorrow? Ryan used to joke about it. Dude, why are you always preparing for something bad? Chris would laugh. I'm not preparing for something bad. I'm preparing for something normal. Ryan didn't understand. Why spend time thinking about crashes? America had always recovered. The market always came back. Things looked great. Jobs were strong. Home prices kept climbing. Banks were handing out loans like candy. It felt like nothing could go wrong. Sound familiar? Because that's exactly how people felt before a lot of financial crises. Not just in 2008, before 1929, before the dot-com crash, before countless market bubbles throughout history. The biggest risks usually don't feel risky until it's too late. One sentence changed everything. Years earlier, Chris's grandfather gave him a small notebook. Inside, there wasn't a list of stock picks. There wasn't a secret formula. There weren't any predictions. Just one sentence. When fear takes over, watch where the money runs. Chris didn't understand it at first, so he asked, what does that even mean? His grandfather smiled. When people feel rich, they chase opportunity. When people feel scared, they chase safety. And if millions of people start chasing safety at the same time, some assets become a lot more valuable. That conversation stayed in Chris's head for years, not because it sounded smart, because it sounded logical. Here's the mistake almost everyone makes. Most people think investing is about predicting the future. It's not. Think about it. If you knew exactly what the stock market was going to do next year, you'd be one of the richest people on earth. Nobody knows. Not economists, not billionaires, not the people on financial TV. In fact, history is full of experts making terrible predictions. That's why Chris stopped trying to predict. Instead, he started studying patterns. He spent months reading about the biggest financial crises in American history: the Great Depression, the inflation crisis of the 1970s, Black Monday, the dot-com bubble, the housing crash, COVID. Different causes, different headlines, different decades. But one thing kept showing up. Whenever fear spread through the financial system, money started leaving certain assets and moving into others. Not because those assets were perfect, because investors believed they offered something people suddenly wanted: safety, stability, or protection. And that's where Chris found something fascinating. Throughout many of America's biggest financial crises, 4 types of assets kept showing up over and over again. Not every time, not in exactly the same way, but often enough that ignoring the pattern would be a mistake. Ryan laughed when Chris first mentioned it. So what are they? Chris smiled. If I tell you now, you'll probably buy them for the wrong reason. Ryan looked confused. What do you mean? Because if you don't understand why they worked, they're just another list on the internet. and that's not going to help you. So, let's start with the first one. At first, it sounds obvious, until you realize most people don't actually understand why it worked. Ryan couldn't wait anymore. So, what's the first asset? Chris smiled. It wasn't gold. Ryan looked confused. Wait, I thought everyone says buy gold during a crisis. Chris nodded. Gold mattered, but the real surprise wasn't gold. It was the companies digging it out of the ground. Ryan frowned. Gold mining companies? Seriously? Why would they do better than gold itself? Chris laughed. I asked the exact same question, and once I understood the answer, I never looked at markets the same way again. Asset number 1. Gold mining companies. Let's go back almost 100 years. America. The stock market crashes. People panic. Banks begin failing. Businesses shut down. Millions lose their jobs. By the time the worst of the Great Depression was over, the U.S. stock market had lost nearly 90% of its value from the peak. Think about that for a second. Imagine saving for 20 years. You finally build a portfolio worth $100,000. Now imagine opening your account and seeing only about $10,000 left. That's what many investors experienced. It wasn't just losing money. It was watching decades of savings disappear. Ryan shook his head. I can't even imagine that. Chris nodded. Most of us can't. And that's why it's important to study history. But then, something strange happened. While thousands of companies were struggling just to survive, a handful of gold mining companies were doing incredibly well. One of the most famous examples was Homestake Mining. While much of the stock market was collapsing, Homestake's stock produced remarkable returns during the Depression and continued paying dividends when many companies couldn't. Ryan looked confused. How is that even possible? The whole economy was falling apart. Chris smiled. Because you aren't asking the right question. The question isn't, was the economy bad? The question is, what happens when millions of people suddenly want gold? Here's why. Imagine you own a lemonade stand. Each cup costs you about $1 to make. You sell it for $2. So, you make $1 profit. Now imagine everyone suddenly wants lemonade. You raise the price to $3. Did your lemons suddenly cost 3 times more? Probably not. Maybe your costs go up a little, but not nearly as much as your selling price. Now, instead of making $1, you're making $2. Your sales only increased by 50%, but your profit doubled. That's exactly why gold mining companies can sometimes outperform gold itself. When the price of gold rises, a mining company's costs don't always rise at the same speed. That means profits can grow much faster than the gold price. But don't stop there. Here's something finance influencers rarely mention. Gold miners can also crash hard. Gold miners aren't some magical investment. Chris's grandfather never said, buy gold miners. He said, understand why they sometimes become valuable. Those are 2 completely different lessons. Ryan nodded. So this isn't really about gold. Chris smiled. No, it's about understanding where money runs, when fear takes over, and history kept repeating it. Ryan smiled. Okay, I'll admit it. I've learned more in the last 10 minutes than I did watching finance videos all week. Chris laughed. Good, because the next one is even stranger. Ryan raised an eyebrow. What could be stranger than gold miners? Chris looked at him. The U.S. government. Ryan looked at Chris. All right, you've convinced me about gold miners, but don't tell me the second asset is bonds. Chris grinned. It is. Ryan laughed. Come on, nobody gets excited about bonds. Exactly. Chris took a sip of his coffee, and that's why they're so easy to ignore. Asset number 2. Long-term U.S. Treasury bonds. Let's jump ahead to 2008. The housing market is falling apart. Banks are failing. Companies are laying people off. Every day, the news gets worse. Investors around the world are asking the same question. Where can I put my money? Not, where can I make the biggest return? But, where can I survive this? Those are 2 completely different questions. And when enough people start asking the second one, the market changes. Ryan interrupted. So, why didn't everyone just keep their money in cash? Chris nodded. Some people did. But if you're managing billions of dollars, cash isn't always your first choice. Imagine you're running one of the biggest pension funds in America. You manage retirement money for hundreds of thousands of people. The stock market is falling every single day. Your job isn't to gamble. Your job is to protect that money. So, where do you go? Historically, one answer has often been U.S. Treasury bonds, because they're backed by the U.S. government. That doesn't mean they're perfect. It doesn't mean they never lose money. But during many financial panics, investors have viewed them as one of the safest places to park their money. And when billions of dollars all start moving toward the same thing, its price usually goes up. Ryan frowned. Wait, I thought bonds paid fixed interest. They do. So why would the price go up? Chris smiled. Good question. This is where people get confused. Think about concert tickets. Imagine Taylor Swift announces one last concert. A ticket originally costs $200, but millions of people suddenly want one. The ticket itself didn't change. The seat didn't get bigger. The music didn't get better. The only thing that changed was demand. Now people are willing to pay $600 for that same ticket. Treasury bonds work in a similar way. When fear spreads, demand often increases, and higher demand pushes prices higher. It's basic supply and demand, not magic. Ryan nodded. So investors weren't buying bonds because they expected huge profits. They were buying them because they trusted them more than stocks. Chris pointed. Exactly. Sometimes the best performing asset isn't the one everyone loves. It's the one everyone trusts. 2008 proved the point. During the financial crisis, many stock portfolios were getting crushed, but long-term U.S. Treasury bonds performed very differently. As investors rushed toward them, bond prices rose. For people who owned both stocks and long-term treasuries, those bonds helped offset part of the losses elsewhere. Not all of them, but enough to make a painful year a little less painful. That's one reason many large investment firms don't put all their money into stocks. They know different assets respond differently to different economic conditions. But here's the part you almost never hear. Ryan smiled. So bonds are basically a cheat code? Chris laughed. Not even close. In fact, they can get crushed too. Ryan looked surprised. They can? Absolutely. Fast forward to 2022. Inflation jumps to levels America hadn't seen in decades. The Federal Reserve raises interest rates aggressively, and suddenly, long-term Treasury bonds have one of their worst years in modern history. Ryan looked confused. So the same thing that helped people in 2008 lost people money in 2022? Chris nodded. Exactly. And that's probably the biggest lesson in this whole video. There is no perfect investment. Every asset has conditions where it tends to perform well. Every asset also has conditions where it struggles. Gold miners, treasuries, stocks, real estate, everything. The goal isn't to find something that wins every time, because it doesn't exist. The goal is to understand why an asset performs the way it does. Once you understand the reason, you stop following headlines. You start following incentives, and that's a much better way to think about investing. Ryan looked down at the notebook again. 2 lines were now checked off. Gold mining companies, long-term U.S. Treasury bonds. He smiled. You know what's weird? I thought this notebook was going to tell me what to buy. Chris laughed. My grandfather would have hated that. Ryan looked confused. Why? Because he didn't write it to tell me what to buy. He wrote it to teach me how money behaves. Ryan sat quietly for a moment. Then he asked, So what's number 3? Chris smiled. It's something almost every one of us uses, at least 3 times a day. Ryan thought for a second. Gas? Chris shook his head. No. Food. Ryan frowned. Food? Chris nodded. And that's where things get really interesting. Ryan looked at Chris. Okay, so gold miners make sense. Treasuries make sense. But you seriously think food belongs on this list? Chris smiled. Not food. The thing that produces it. Ryan thought for a second. Farmland? Chris nodded. Exactly. Asset number 3. Productive farmland. Think about your day. Yesterday. Maybe you skipped Starbucks. Maybe you didn't buy new shoes. Maybe you canceled Netflix. But I'm willing to bet you still ate breakfast. You probably had lunch. And unless you're watching this at 2 a.m., you'll probably eat dinner too. That's the point. When money gets tight, people stop buying a lot of things, but they don't stop eating. Ryan nodded. Okay, I get that. But how does that help farmland? Chris smiled. Because farmland isn't valuable just because it's land. It's valuable because it produces something people need. every single day. Corn, wheat, soybeans, vegetables, fruit. The economy can slow down. Demand for food usually doesn't disappear. That's a very different business from selling luxury watches or sports cars. Here's something most people don't think about. Imagine you own a company that sells designer handbags. During a recession, a lot of people decide, you know what? I'll wait another year. Sales fall. Now imagine you own productive farmland. Families may eat at cheaper restaurants. They may buy store brands instead of premium brands, but they're still buying food. That doesn't guarantee higher profits, but it does mean demand for what the land produces tends to be much steadier than demand for luxury products. That's one reason farmland has attracted long-term investors for decades. Ryan interrupted. So that's why people like Bill Gates own farmland? Chris nodded. Partly, there isn't one reason, but productive farmland has characteristics many long-term investors like. It can generate income, it produces essential goods, and unlike technology, they're not making millions of new acres of farmland every year. Ryan smiled. So supply is limited, but people keep eating. Exactly. But don't think it's perfect. Chris looked serious. And this is where a lot of videos become misleading. Farmland has had painful periods too. Back in the 1980s, America went through a major farm crisis. Interest rates shot up. Many farmers had borrowed too much money. Land prices in many areas fell sharply. Some families lost farms that had been in their family for generations. Ryan looked surprised. So farmland can crash too? Absolutely. If somebody tells you an investment never has bad years, stop listening, because history doesn't work like that. Every asset has risks. The question isn't, does it ever go down? The question is, why does it go up, and why does it go down? Once you understand that, you're already ahead of most investors. Something clicked. Ryan looked back at the notebook. 3 assets, 3 completely different industries: gold, government bonds, farmland. At first, they looked completely unrelated. Now, they all made sense. Gold often benefited when investors wanted a store of value. Treasuries often benefited when investors wanted perceived safety. Farmland benefited because it produced something people needed, regardless of the economy. Different assets, different reasons, same pattern. Money follows human behavior, not headlines. Ryan smiled. I think I'm starting to understand your grandfather. Chris laughed. Good, because the last asset is probably the simplest one, and somehow, almost everyone overlooks it. Ryan raised an eyebrow. What is it? Chris pointed across the street. A family walked out of a grocery store carrying shopping bags. Then another. Then another. Chris smiled. Watch what people buy when they're trying to save money. Ryan watched families walking in and out of the grocery store. Some had full carts. Some carried just a couple of bags. But one thing stood out. People just kept coming. Ryan looked at Chris. So, what's the last asset? Chris smiled. It isn't one company. It isn't one stock. It's an entire group of businesses. Ryan waited. Chris finally said, consumer staples. Asset number 4, consumer staples. Think about the last recession, or honestly, think about your own life. When money gets tight, what's the first thing people cut? Vacations, eating out, new phones, new TVs, new furniture. Those are all things people want. Now think about what they usually don't stop buying. Toothpaste, milk, soap, medicine, laundry detergent, diapers, toilet paper, coffee, bread, eggs. These aren't exciting products, but they're necessary. And that's exactly why businesses selling them often hold up better during economic slowdowns than businesses selling luxury or discretionary products. Ryan smiled. So, boring wins. Chris laughed. Sometimes. And that's the funny thing about investing. The assets that get the least attention during good times sometimes become the most valuable during bad times. Let's go back to 2008. The financial crisis hits. People stop spending. New home sales collapse. Luxury retailers struggle. Car sales fall sharply. Travel slows down. Businesses selling optional products suddenly have a problem. Customers disappear. Now look at a grocery store. Families may switch from premium cereal to the cheaper brand. They may cook at home instead of eating out. They may stop buying snacks, but they still need food. The same thing happens with household products. People might buy a cheaper bottle of shampoo. They're probably not going to stop washing their hair. That's why companies selling everyday essentials have often been more resilient during recessions. Not because they're immune, because demand tends to stay more consistent. Ryan nodded. I think I'm seeing the pattern. Chris smiled. Tell me. Ryan looked at the notebook. Gold wasn't really about gold. It was about confidence. Treasuries weren't really about bonds. They were about safety. Farmland wasn't really about farms. It was about necessity. Chris nodded. And consumer staples? Ryan smiled. They're about habits, the things people keep buying, no matter what's happening. Chris pointed at him. Exactly. The notebook never taught investing. Ryan looked down at the 4 categories one last time. Gold mining companies, long-term U.S. Treasury bonds, productive farmland, consumer staples. 4 completely different assets, 4 completely different industries, but one common idea. Money follows human behavior, not headlines, not opinions, not predictions. Behavior. The biggest lesson wasn't about the 4 assets. Chris closed the notebook. You know what most people are going to do after watching this? Ryan shrugged. They'll Google best gold mining stocks. Chris laughed. And that's exactly what my grandfather hoped I wouldn't do. Ryan looked confused. Why? Because that's missing the point. He continued. If all you learned today is 4 assets, you missed the lesson. The real lesson is understanding why money moved, because the next crisis probably won't look like 2008. It won't look like the Great Depression. It won't look like COVID. The headlines will be different. The technology will be different. The politicians will be different. But people? People will probably react in familiar ways. Some will panic. Some will sell everything. Some will chase whatever worked last time. And a small group will stop, look at history, and ask a much better question. What is money likely to do when fear takes over? That's a completely different way of thinking. And over the long run, it can lead to completely different decisions. 6 months later, Ryan and Chris met again. Same coffee shop, same table. The market was still unpredictable. Nobody knew what the next year would bring. Ryan smiled. You know what's changed? Chris looked up. I don't feel like I need to predict the future anymore. I just want to understand it better. Chris grinned. My grandfather would have loved hearing that, because the smartest investors in history weren't the ones who predicted every crash. They were the ones who understood that markets are driven by people, and people have been driven by fear and greed for centuries. That's why history still matters, not because it tells you exactly what's coming next, but because it reminds you how people usually behave when it does. If there's one thing to take away from this video, it's this. Every crisis tells a different story, but human behavior keeps repeating the same chapters. The investors who understand that often make calmer, smarter decisions than those chasing the latest headlines. So the next time someone says, "This time is different," take a step back. Open a history book. You might be surprised by how familiar it feels. If you enjoyed this video, subscribe to Decoding Wealth. Every week, we break down the stories, psychology, and history behind money, so you don't just follow the market, you understand it. Thanks for watching.